Of course, it's hard to tell when that trade deal might come through. Any sense, any inkling you can share with us?
Thank you, Haslinda. Good to be back on your show. To be honest with you, right now it's very difficult to put a timeline to it because we all know very well by now, I think, through multiple rounds of conversations, most of the trade-related issues have been sorted out. And therefore, I believe this is as much a matter of geopolitical developments as it is a matter of bilateral trade issues. So that's why it has become difficult to give you a timeline on this, Haslinda. Back to you.
It remains a big question mark for markets, for investors, for economists. They're tracking that deal really closely. If there is no deal, even by the end of this year, what implications are there for India's economy, you think?
Well, I mean, this year we have only about 2.5 weeks or so to go. So I think, as you played a clip of your conversation with the Pranjul Bhandari. I think, like her, I would also be surprised if we don't have one lined up or sealed down. I'll be surprised if we don't have a deal sealed by the end of the financial year. I was anticipating that, I was hoping that something would be done by end of November, but it has turned out to be elusive. I agree with you that it has had an impact on investor sentiment. And as and when the deal is sort of agreed upon, and definitely there will be a huge sort of a weight lifted off the shoulders of the Indian market, so that risk premium will dissipate. So that is for sure.
How is that uncertainty playing and shaping into how you look at the budget for 2027? I mean, what are your key considerations when it comes to that?
No, I mean, obviously, trade uncertainties do play a part in how we project the GDP numbers. But nonetheless, I think, as you may have been noticing in our data, the domestic economy is doing rather well, and the exporters themselves have been able to withstand the effects of the tariff and partially offset its negative fallout by diversifying into other markets. There is no gainsaying the fact that it has had an impact on specific sectors, and they are significantly, affected. But nonetheless, considering the kind of fears that they entertained back in August, I think their own resilience has come out rather well than before. So, as far as we are concerned, I think we are quite positive that the underlying economic momentum in the economy will support economic growth outlook for 26-27, and thus underpin our revenue, fiscal deficit numbers, etc.
The question is how strong the Indian economy will grow in 2026. We saw pretty much better than expected GDP, especially for the first half of the year. How much momentum, how well supported is that? Or is it a one-off?
No, I don't think it's one-off. If anything, I would rather argue that we are beginning to see the lagged and the cumulative impact of the various structural reforms that this government has undertaken since 2014. The investment in public infrastructure, the massive rollout of the digital public infrastructure, and then other structural reforms like GST, insolvency, bankruptcy code, and the continued sustained efforts to bring small and medium micro enterprises into the formal sector of the economy. If you put them all together, I think we are beginning to see a certain impact on potential growth rate, and we are waiting for the new base year revisions and methodological revisions to be rolled out in February, March of the coming year. Then we will be able to get a better handle on the potential growth numbers. But my gut feeling is that India's potential growth has moved higher on account of these decade-long structural reforms. So it is not a one-off thing. I expect it to sustain in 26-27 financial year.
Yet, the RBI says you can expect India's growth to soften somewhat. How do you read that? Or do you disagree?
Well, I mean, RBI has... I'm sorry, go ahead.
Do you disagree?
No, I don't disagree. I mean, in the sense that RBI has revised its growth forecast for the current financial year to 7.3%, its estimate rather than forecast at this stage. So the growth estimate for 25-26 is 7.3%, and therefore for the next financial year, they are predicting a number that is around 6.7% in real terms. I mean, that's kind of understandable because of the base effect and so on. So at the same time, every year in the last 5 years post-COVID, the economy has surprised us with better good performance than what we anticipate early in the forecasting cycle. I will not be surprised if something like this happens for 26-27 as well.
How about consumption, Van? How strong is it? We know that it's been well supported by the GST reform, but some say that impact, will ease going forward.
Well, not really. If anything, I would argue that the consumption story will become stronger, particularly in urban India. It is very well documented right now that rural consumption is actually faring extremely well on the back of two successive good monsoons, on the back of real wage growth, income growth in rural India. Agricultural production is doing well. If anything, as you can see in the sustained decline in the uptake of the National Rural Employment Guarantee Program, it is very clear that rural residents are finding employment opportunities elsewhere, that they don't have to fall back on the national government-run Rural Employment Guarantee Program. And that is the clearest possible indication that rural economy is in very good shape. Urban India, of course, I think the GST cut, and we should not forget the direct tax relief provided in the budget earlier this year, and the fact that inflation itself, particularly food, which constitutes about a third or slightly more of your monthly consumption basket, that is low. So putting more disposable income in their hands as well. And that is the reason why India's household savings rate, which went to as low as 4.9% of GDP in 22-23, has risen to 6% of GDP. Financial liabilities have come down in absolute rupee terms in 24-25. So all of the commentators who were quite concerned about the declining household savings rate haven't covered the improvement in material improvement in the household savings rate as much as they lamented its decline. So that is also another indirect validation of the state of the income and the balance sheets of the Indian households. Therefore, consumption should be well supported going into 26-27 financial year.
Isn't it true, though, that household consumption would depend on where the rupee goes from here? After all, we have oil, fertilizers, edible oil, raw materials. They're all priced in USD. And with the Indian rupee in the doldrums, household consumption may get impacted.
Well, not really, because we have done our homework and we covered it in the economic survey published earlier this year in January. On a net basis, a weaker rupee does improve the Indian trade balance. So we have taken into consideration all the things that you mentioned. So on a net basis, taking into account the impact on exports, taking into account the impact on imported commodities, which are priced in dollars, as you pointed out, the net effect is still a positive in terms of trade balance, and that which means the extra income, everything else being equal, that may accrue to exporters does offset the import drag. And let me point out, the wholesale price index is, almost in deflationary regime at the moment, and that is because of low import prices. Oil prices have remained stable. Metal prices are generally very well behaved. So, in that sense, the underlying inflation pressures being absent in imported commodities, therefore, having a rupee weakness at this point isn't going to be a major problem, as it is a good benefit for the export sector given the global uncertainties. Therefore, all things considered, it will be at the margin a positive reinforcement to consumption story rather than being a drag.
So, from all of that, is it fair to assume that you're not too concerned about rupee weakness right now? It is hovering at close to record lows.
Look, the rupee weakness reflects the fact that, as you pointed out at the beginning of the conversation, investors are kind of sitting out at this moment, and therefore the rupee is undershooting its economic fundamentals. If you look at the macroeconomic dashboard, whether it is economic growth or inflation, external deficit, or the banking system, or the resilience of consumption, corporate profitability, you can tick all those boxes and they're all green as far as India is concerned. So clearly, there are times when financial markets fixated on particular aspects, optics that they're looking for, such as the trade dispute, trade agreement conclusion, etc. And recently, the artificial intelligence boom also drives capital to particular sections of the global economy. So all these things have kind of cast a shadow on the rupee, but it is reaching a point where the rupee will be substantially undervalued relative to the economic fundamentals that India has, and that will begin to reflect in the performance of the Indian rupee in the coming years.
Right. So rupee undervalued, not reflecting fundamentals of the Indian economy. Right. How much undervalued is it? What is fair value then?
Look, I mean, that is a bit difficult. I don't have numbers off the top of my head. If you look at the real effective exchange rate, I think the Indian rupee is undershooting the RBI's real effective exchange rate calculations. It has dropped, it has depreciated significantly in real effective terms against other currencies as well. So I have a feeling that the rupee could be somewhere, and I haven't done my estimate, anywhere between, you could take a very wide range between 5 to 15% undervalued in real effective terms. But as I said, I have to do my numbers on it. I'm not talking purely with respect to the US dollar. I'm talking in real effective terms.
We have the IMF weighing in on the policy that's been adopted by the RBI. It says that the RBI is guiding the currency, is not gutting the currency. What do you make of the approach taken by the RBI? Does it need to do more to support the currency, or are you happy with how it's being done right now?
And the central bank is doing a very good job of making sure that excess volatility is handled and addressed. The fund is entitled to its own perception based on a very short 6-month window during the observation period. And on that basis, they just calculate whether the rupee has moved in either direction above a particular percentage threshold. And if it isn't the case, they do classify the exchange rate arrangements accordingly. However, it must be noted that they have sort of upgraded and acknowledged the fact that the rupee is indeed more floating than they reckoned last year. So I think the central bank is doing a good job in terms of making sure that the currency volatility is not unduly excessive.
Given that the Fed is expected to cut rates further, that could mean a weaker dollar. Do you think that essentially will provide some support for the rupee?
That could be one of the factors, but I do believe, as I mentioned earlier, India's fundamentals themselves will begin to get reflected in the currency once the financial market and direct investors begin to see the rupee undervalued levels as an attractive entry option. That is one point. So India's domestic fundamentals will have a large influence on the rupee recovering from its undervalued levels in the coming years. But as you said, the potential for rate reductions or negative real yields and many other developments in overseas markets and economies will also act as tailwinds for the Indian rupee. They are too numerous at this point to list down here.
A lot of countries are grappling with sticky inflation, but that's not a problem in India. In fact, the RBI expects inflation in India to be at about 2% next year. Is low inflation good for the Indian economy?
I think so. I mean, obviously, we have grappled with 6 to 7% inflation annual average for the first 6 to 7 decades since independence. I think our inflation rates are converging, and it is a testimony to the fact that I pointed out earlier, Haslinda, that the cumulative and the lagged effects of the structural reforms have relieved the supply side constraint that the Indian economy used to face, which used to result in overheating reflected in multiple dimensions. conditions, inflation, overvalued exchange rate, banking system stress, etc. And I believe that we are on a path to sort of, creating a longer time horizon during which the economy is able to grow sustainably with moderate inflation. So I think if it does create a good avenue for productivity-led growth in the coming years. And I would therefore argue on balance that Indian inflation rate converging to lower levels is a good thing for the Indian economy and reflects the structural reforms effects that we have undertaken in the last 11 years.
But in a way, it is a balancing act, right? Because, I mean, at some stage, low inflation would impact your fiscal position. It could be a reflection of weak demand. Is there a level of inflation that would make you worry because of these concerns?
No, obviously, if we have a sustained inflation rate of 2% or below at the consumer price level, then we will have to see. But even there, I think it all depends on multiple factors. We may be underestimating the buoyancy, the coverage of the taxpayers brought into the Indian economy through formalization, through technological interventions, etc. So there are multiple factors at work that will have implications for fiscal balances. The low inflation obviously means a boost to real incomes compared to historical averages, more disposable income, more purchasing power, and therefore that will also result in better growth in real terms, and the quality of the growth composition will therefore be higher. Therefore, it is not necessarily a given that low inflation means lower fiscal revenue mobilization, etc. There are multiple factors at work here. I wouldn't conclude on that. I wouldn't conclude that way purely because inflation is going to be significantly below historical averages.
Van, I want to take a look at recent developments to do with Indigo, how more than 3,000 flights were cancelled on the back of developments there. Given that travel and tourism accounts for, I think, about 3% of GDP, I mean, how are you looking at developments there, and how concerned are you about what we saw recently?
Haslinda, I'm not a equity person, and I do believe, and I also heard the statement made by the chairperson of the company. I think the traffic conditions, the normalization of the availability of planes has been restored. The Ministry of Civil Aviation and DGCA are looking into it. And in a way, I think, as always the case in macro situations or in similar corporate situations, a development of this nature will only mean better systems and better resilience going forward. So I think I do see the bright side of these kinds of developments, no matter how extremely stressful and difficult it has been for some of the passengers, for a lot of passengers. But I think in the long run, this would make the Indian aviation system, apart from the company itself, stronger and better for it in terms of planning, in terms of long-term thinking, etc.
I stand corrected. In fact, the Travel and Tourism Ministry accounts for about 7% of GDP. To that point, then, I'm just wondering, how are you assessing the risk? I mean, 7% of GDP is substantial if you see continued problems in the aviation space.
No, I don't think so. I think, naturally, since the event is very recent, there is a tendency to overanalyze or amplify the impact. But as and when and it will not be easy, I agree, for the company to live down the last one week or 10 days of difficult developments. But if they are able to sustain better operations and more reliability, this will slowly fade into the background. And I think the market is growing on the back of higher purchasing power and disposable incomes. I don't see a long-term impact of this on the Indian domestic or foreign tourism into India.